Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the free live Market Chameleon webinar series. Before we get started, let's take a look at the share disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, let's welcome Dimitri Pargamonic to the stage. We'll be talking about screening for bear put spreads in a downward market. How are you doing today, D?
Good morning, Will. How are you?
Great. Let me share your screen. And actually, let me remove the disclaimer. Share your screen.
Okay.
All right, there we go.
Good morning, everyone. So today we'll talk about screening for bearish put spreads, and I'm going to do some quick kind of examples as starting points. And let's first go to the put spread screeners. I'm going to go up top here. We're on the main menu. If you hover over that, one sec, and click on bear put spreads. It'll take us to the main screener. And as you can see here, we have our filters here above with different tabs and the data elements below. So we're going to do like a quick screen because actually I'm going to Pittsburgh again today. So don't have much time, but I'll kind of just go over some of the data elements to get people started. And the idea behind the idea behind today's example is when we're looking for bearish put spreads, sometimes if our outlook is that the market is going down, or we want to hedge against a potential downward market, then just screening for bearish put spreads in general could offer some protection, because if the entire market goes down, the kind of simple logic would be that everything gets pulled down with the market, right? So if the market goes down by enough, then things go to kind of like one beta, and even the strongest stocks would get pulled down eventually with it. So if we take that perspective, then we may not necessarily be looking at a particular stock where we think, okay, my outlook on this particular stock is bearish, which you can still do. But in this example, we're just going to take a look at any bearish put spread. So right now we are defaulted to the next monthly expiration, November 21st. I'll keep that in there. And what we'll do is maybe our first screen will be, well, what are other people trading? What are some of the most active bearish put spreads out there as our starting point? So to do that, we're going to go up here and click on volume analysis. And if we go from left to right, we could see NVIDIA shows up a lot of times here because this is sorted by highest market cap. And as you know, there are different combinations of put spreads, because even within the same month, you could see there are different strikes. Like over here, buying the 190 strikes on the 185 strike, buying the 190 strikes on the 187.5 strike, the 215 strike, 210 strike. So when we look at different put spreads, there are many different combinations using different expirations and different strikes. So now what we want to do is kind of keep going from left to right. And here we see some of the data statistics for each of the legs. So we could see on the one leg, the buy side, there's 6,500 contracts, 17,000 open interest, 14,000 volume in the sell side. strike, 39,000 open interest. But all the way over here, this shows us the trading on the day in the multi-leg trades. So in the multi-leg trades, we go detect them and we find that there are these bearish put spreads in these particular expiration and strikes. So if we just look at this volume and click on it, it'll start sorting these lows to highs, highs to lows. So let's click on it again because these are the lowest. So let's go from highest. So now we see 82,000 contracts in total traded in the IWM November 21st, 232, 230 put spread. Right. So buying. So if we look at this $2 put spread, and then we kind of slide over and say, okay, well, right now the ask price is 42 cents. Right. We could look at the mark here. I'll show you what it looks like in the market data. Here's the bid for this spread is 35 cents. The offer is 42 cents. So you could see it's already 7 cents wide. So we're kind of looking at the 42 cents as this is the current offer if we're looking to buy a put spread, and we start the valuation there, right, at the 42 cents. And of course, that doesn't mean, your execution, or you want to try to get the best execution possible. That could be anywhere 42 cents or below. But let's go back to the volume analysis. So here we see 82,000 contracts traded in this put spread for a VWAP price of 36 cents. And at the time, the market was 33 cents, 37 cents. So the market was a little bit tighter than the one we last saw. And it traded at a price that was slightly better than the ask. Right? The ask was 37 cents. It traded. So there was a little bit of a price improvement closer to the midpoint, which is important also for, quality of execution or how you place your trades to see how, the trading activity and where things are getting executed relative to the market. And we see a couple in SPY. So here in SPY, the 645, 641 put spread, 641 put spread, 638. And similar, this one traded closer to the bid. This one traded closer to the bid. So from the perspective of that, we got 3 put spreads, the top 3, and we could keep going, and now we have a sense of, how much trading was involved in these put spreads. This one traded 5 times for a total of 32,070 contracts. This one traded 2 times. This one traded 1 time. And we see where relative to the bids and offers they traded, and perhaps, that gives us an idea where potentially you could try getting an execution if you like these types of trades. Maybe this one you maybe able to get closer to the bid. Maybe this one closer to the bid as a buyer, that would be great. This one maybe a little bit less than the offer. So that's one thing. We could also look at how are these put spreads right now relative to historical values. If we use historical benchmarks, come here in summary, and we could see that while this put spread is offered at 42 cents, using historical benchmarks, an average price based on how the stock price moved is 45 cents. This one's 43. This one's 27. So this gives us an idea of where the prices are, market prices, versus where the average historical price would be based on how the stock moved in the past. Where on a relative basis, is it on the higher, lower end of the historical range? We could do the same thing with IV historicals. If you click on this will use historical implied volatilities. So you see here, these would be the benchmarks. So these are all trading now above on the higher end. How high? Well, using 42 cents, that would mean 92% of the observations were below. Only 8% were above. If we use the 50 cents here, 84% were below, 16% were above. So these are now on the higher end of the historical range, but it gives us an idea where the pricing is, where the traded prices are. So here we can make quicker decisions. Another quick analysis is, let's say we thought there's some downside risk and we wanted to see, well, what would the payoff be on these strategies if we moved one standard deviation down, right? So one standard deviation seems like, okay, that's a potential, between now and expiration, we're down one standard deviation. What would these pay off, right? Like a quick scan. So we could go to strategy payoffs. So here, these are showing us those top three. And here, this gives us payoffs on different types of movements. But this one is down one standard deviation. So if the stock is down one standard deviation, this particular spread in IWM would return 124%. So it would be, so whatever, it is now based on that expect one standard deviation move, this spread would be at expiration up 124%. You could see the IWMs, they would need a bigger move. So one standard deviation move is not enough for these spreads, right? Because here you can see the stock's 240. We're looking at the 230, 232 spread. This SPY is 669. Looking at the 641, 645 spread is further out of the money, more than one standard deviation. So that's why it's not hitting profitability yet. You'd have to go probably two standard deviations. So this is kind of just showing us at the one standard deviation level. So what we did was a quick, you could see in a couple minutes, what we did was just take a quick look at potential ways to either hedge or use the assumption if the market is going down, right, and the other stocks may be pulled down with it, you could keep going down the line. What are potential bear put spreads? And as starting points, we could look at, well, what are people trading out there? Because now it kind of establishes a fair value. What were the prices they were trading at relative to the market? So now I have an idea what type of execution or price execution, or where I could place my my potential orders relative to the markets to improve the quality of execution. And where are they trading relative to historical values, and what are my potential payoffs? So you could see how quickly we're able to do that just tabbing through these. We just sorted and just kind of looked at the data elements really quickly to see, well, if this is interesting, that we could go and do further research on. Well, I'm going to stop right there because I think I covered, I think enough, parameters.
Yeah, that was great. That was a great webinar, D. Thanks for bringing it. You have a safe trip to Pittsburgh, and we'll see you on Monday, my friend.
All right. Thanks, everyone, for joining. Have a great weekend. Stay safe out there. Have a great trading day, and we hope to see you Monday.
Have a safe day, D. Bye. All right, everyone. Thanks for joining another Market Chameleon webinar. Remember to like and follow us on all the social platforms. If you're on YouTube right now, thumbs up. It's great to see Swami back, even though he may be on a horse tranquilizer. I'm thinking of that movie where Farrell gets a tranquilizer right in the jugular and starts talking. Everyone, have a great day. Stay safe out there, and we will see you on Monday. Bye.